Okay, so today I'm going to briefly explain this trade that I took this morning and how I went about entering this trade and managing this trade. Okay, so let's get straight into it. Understand that first off, I trade YM only. I've been trading over 7 years. I trade between 8 a.m. and 11 a.m. Eastern Standard Time, and I give myself 3 shots to get a trade right. If I cannot get it in 3 trades, it's just not there for me that day. To go deeper into that real quick, I take trades at specific times. So I got macro entry, or I call macro execution times: 9:30, 9:45, 10 o'clock, 10:30, 10:45. These are my specific entry times based on most of the trades I've taken in the past. These are like the specific times I tend to enter based off of what price is doing at those times. Two critical factors have to be present. Price has to be taking out liquidity or have taken out liquidity, and price has to tap into a fair value gap, a supply or demand zone. Sometimes that fair value gap, supply and demand zone is may or may not be present. Majority of the times it is, but liquidity must be taken out in order for me to take any type of trade. So I'm gonna break down today's trade. All right. So first thing first, when I get on the charts, is I look and see where liquidity is for today. Okay. What's obvious that we could go into and take out, and what direction could the market possibly want to go in? So today, the market opened up here at 8 o'clock. We had already did a bullish engulfing candle. It formed a fair value gap. It closed above London and Asian. So my first mind was thinking the market may want to continue bullish because this is actually a setup that I would typically take, right? But since it happened so early, it wasn't something I was looking to take the buy off of. As you see here at 8:15, they came right into that fair value gap, and then the market began to push up. Now, first area of liquidity I was considering taking a trade after it got taken out was here, yesterday's high, which is also a London high. And that was very close to the previous day's high as well. So you got to understand that above and below every daily candle, or above them at the high and the low of each day, is liquidity resting orders just sitting there. So right here at 9:15, when the market pushed up and actually swept the liquidity from yesterday's high, also taking out London, that was a previous day's target, right? Once 9:15 did that, I wasn't sold just yet on taking the sale. Reason being is because how the 9:15 candle closed. Although it swept that liquidity, it closed a bullish candle and it engulfed into this wick of the 9 o'clock candle. We had already tapped into this fair value gap, so the directional intent from this bullish engulfing candle was already given to go bullish. Okay, 9:30 comes out. When 9:30 comes out, here's the open. Now I'm gonna take you into my entry logic very quickly. Most of my very first trade I usually take on most days, if everything is present, if the setup is there, is 9:30. All I need to see 9:30 do is take out some liquidity and or tap into a fair value gap, a supply or demand zone, and I'm looking to take that trade if the price action makes sense in the moment. I read the opening and the closings of these candles very closely because I understand this. If 9:15 closes here, that means 9:30 candle is going to open here. Once that 9:30 candle opens, if liquidity is above, if a fair value gap, a supply or demand zone is above or below, and the 9:30 candle fluctuates into that, I'm already not necessarily anticipating, but prepared for that candle to possibly turn into a wick rejection and return back to its open to flip down the opposite direction. So today I was kind of thinking it could be a possible sell. When this 9:30 candle came out at first, initially it went right above these highs here and it simply tapped into this fair value gap here. So you have a tiny fair value gap right here, and it left a wick into that fair value gap, and it was hesitant. It was fluctuating a lot as if it wanted to go ahead and wick out from there and flip back down. So I pulled the sale once we were up here. It threw out a wick. It started to flip down. As you can see, it started to go down. So at first I'm thinking, okay, here's the sale. I'm going to target London and yesterday low, obvious target. It fluctuated all the way down and made this low. And then it pretty much tapped into this area here, which is kind of like a demand zone because this candle took liquidity and filled in the fair value gap, so it can act as demand zone. This candle also swept the previous candle's high. So this candle is a single candle order block. It can be used as a supply or demand zone in this case. When they came back down and they kind of swept the 9:15 candle, then they started to flip back up. I pretty much got stopped out with this candle here, 9:30. So then 9:30 goes up and closes bullish. Okay, great. Now, in most cases, I would typically think this is probably going to continue to the upside. But in this case, I did not think that it was going to continue to the upside because we had an even more bigger fair value gap right above us. You can see this here on the 15-minute. On the hour time frame, it's a massive fair value gap. So one thing I understand through back testing and experience, fair value gaps tend to get closed with a new gap. So I was confident that if the market wanted to continue up, they would close this gap and form a new gap. 930 candle taps into the supply. It closed bullish, so I'm not looking to take a sell just yet or buy. I'm still being patient, waiting on price action. Then you see the 945 candle comes out, and this is where I actually get into the trade. First thing I noticed about the 945 candle, 930 closed here. Don't mind the little space in between. Sometimes that happens with price. It's not always perfect. This 945 candle opened here, and at not one time did it fluctuate down at all. It did not leave a wick or anything to the opposite side. Candles like this, it takes time to learn these candles, but when you see candles like this, they can be easy telltale signs that the strength is present, but a shift in momentum is happening, depending on where this candle happens or appears on the chart. So 945 candle opens here and they fluctuate all the way up. Again, if my opening is here and this candle begins to fluctuate up in real time when I'm watching this, if we're fluctuating into liquidity, if we're fluctuating into a fair value gap, a supply or demand zone, in this case, we fluctuated right through this fair value gap into another fair value gap, I am already prepared to execute this trade before the candle closes, seeing that it could potentially begin to form a wick and reject this area and reverse, right? So once this candle fluctuated all the way up to here into this fair value gap and began to leave a wick, I went ahead and pulled this trade right here before it even flipped over and turned back to the open. Reason being is because not only did we go and tap into this fair value gap up here that you can see to the left, we fully respected this current fair value gap was still inside of. So this is a very good sign. And also, if I do this, if I put this in the middle, and I usually have this on here, the middle line, where is it? No, is it not? I can't see it. Let's see, right there. So although we got a very small close above that 50% level, that's a good indication that this fair value gap is holding when price fails to close above the 50% level, or once it rejects and retraces, it comes back below it. So although it closed like right on top of it, this is still pretty clean and clear, okay? Again, it's not always gonna be perfect. So I went ahead and took the trade, put my stops up here. Now, why do I put my stop loss up here? Reason is this: I never put my stop in an arbitrary place. I always put it in a place where the setup would have to be invalidated. And at that same time, once that setup gets invalidated, it would also show me that it's a possibility that the market could continue in the opposite direction. So where this sell trade would get invalidated would be price coming back up here and closing above this 945 candle, meaning we closed, a candle would have to have closed through both of these gaps. And once it's closed through both of these gaps, then I would then look for another candle to pull down and mitigate into the gap to then continue to the upside. So that is why I put my stop loss here. 10 o'clock candle came out. Again, this 945 candle is now a single candle order block. It has taken liquidity by sweeping the previous candle to the left, and it has tapped into the fair value gap space to the left. So being that it is a single candle order block, it can be used as a supply zone. As we see, this 10 o'clock candle came out and mitigated the 945 candle before it continued down. 10 o'clock candle mitigate the 945 and began to flip down. Once this candle closed bearish, this is what I understand. You have a fair value gap here going to the upside. Like I said before, these fair value gaps tend to be what I call directional intents, right? Fair value gaps are almost a form of order flow because it's an imbalance. This window between this candle and this candle, which is all this space in the middle, is a window of imbalance. When you have an imbalance in price, this means that price moves so fast and so rapidly that a lot of orders did not get filled. Okay. What you want to see with these fair value gaps is these fair value gaps hold when the market returns to them in order for the market to continue going in the specific direction that the fair value gap was created in. Being that this candle came down and closed through this fair value gap, creating another fair value gap on the opposite side, now we have an inversion. Okay. And when you have an inversion, this indicates that now the directional intent is for the market to go in the opposite direction, which is why they closed the old gap and created a new gap. Typically, you want to see another candle come back up and mitigate through this inversion and then continue down. So once we closed this gap, I was pretty confident that the market was going to go ahead and continue down. I moved my stop loss from here to here. Why? Because this 10 o'clock candle is now a directional intent candle. If the market chooses to come back up and engulf this directional intent candle, I need to get stopped out here versus here. because this is now the new point of invalidation. If the market would have came back up and engulfed this entire 10 o'clock candle and closed above this 10 o'clock candle, the base of it, that would have told me the direction is changing again and I need to be getting out of this trade. So versus me leaving my stop loss here and taking a big loss once it comes back up, I'd rather take a smaller loss here or no loss at all by going stop, profit, break even. Okay. So once that candle closed, that was great. Now I saw again, this 930 candle swept the previous candle before it went up. So this candle can be used as a single candle order block. In this case, they use the shadow of the 930 candle versus the entire body of the candle. So which is why you see the first wick rejection from the 10 o'clock candle into this demand zone. And then you see the 10-15 candle come into this demand zone and sweep the 10 o'clock candle. Once I saw that sweep, it was a potential that they could fluctuate back up. And again, like I said, come back and return to this inversion and hold this inversion to then continue down, or they could have made the decision to go back up. Next, you have the 1030 candle giving us more directional intent. How? 1030 candle comes out, fluctuates a little bit, and it finally closes bearish engulfing, closes below this 930 demand zone, which is a clear indication that the market still has momentum and strength to the downside, and we want to continue to stay in the sell. From there, as you see, as I just said before, when we close a fair value gap, as you see this bearish engulfing candle came down and closed through this gap, it formed a new gap. And as you can see, the 1045 and 11 o'clock candle mitigated that gap before then continuing to the downside. From there, it was just pretty much a slow coast, slow roll down. We got temporarily held up at this London demand zone here. This candle, 7 o'clock candle, swept the previous candle. So this did act as inducement. So we got minor reactions, but no actual reversal, which was great to see. And then we came into that London demand, and then we eventually reacted to that London demand and then regained strength and pushed on through and took out London demand and the low of the day. So that was today's trade. And that's just some of my price action logic, how I go about reading candle for candle in real time. And yeah, this was just a great trading day. So today's Tuesday. We got the rest of the week. We'll see what we get.